Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith on the video. He did the commentary, so we're splitting the roles this week. And I'm going to keep this week really simple, but that doesn't mean that it's any less important. In fact, I think we got lucky. We're lucky right now that we can really look at the markets in a really simplistic way because of where they are. Now, the most outstanding feature of the week has got to be the Qs. The Qs almost back to all-time highs here, and really on the back of Microsoft, Amazon, Google, all with huge earnings reports, big gaps up today, and that's why you see the Qs gapping the way they are. But that said, it's not three stocks that are propelling this market higher. It's not just the Qs that are higher. It's the S&Ps that are higher as well. In fact, let's just take a quick look at the markets from this perspective. I've got the left side of my chart is the daily chart with the 200-day moving average in gray, the 50-day moving average in magenta, and the 10-day moving average in green. Now over on the weekly side on the right, I've got the 40-week in gray, so that lines up with the gray 200 on the daily. I've got the 10-week in magenta, so that lines up with the 50-day. And then we've got the 65-week, which you should know from listening to Keith. Keith's a big fan of the 65-week number. I agree with it. So let's take a look at the markets this way. So the Qs have basically run away to attempt new highs. And the question is really going to be whether or not the Qs and the SPYs, and to some extent the Dow, can continue to move higher with the IWMs not moving with it. That's the big question. We'll get to the IWMs in just a second. So whenever you got a divergence like that, you want to find a point at which you say that, well, the leaders have now pulled back too far to be considered a bullish mode anymore. Now the Qs, I think that number is pretty far back. In fact, I'm going to tell you when we get to the SPYs that number is the 65-week, and the first warning will come at the 200-day. But the Qs, to say they have to come all the way back to this level, this 200-day or 65-week, would be that would be a dramatic pullback. One of the areas I think we can look for the Qs to find some support if they pull back is all this prior support resistance here around the 111 level. Now I think it could eat into that somewhat and still be fine. And so I think that the key will probably be the SPYs. But if you look at it on the daily, pull back to this 110.80, 111 level would definitely be a healthy pullback. Now some of you might be saying, well, but it's got to fill the gap. Yeah, if you want to say it's got to come back and fill the gap at 109.79 or 109.80, whatever that is, I could believe that too and still be in pretty good shape. All right, so the Qs have plenty of room to fall, so to speak, and still be in decent shape. Now, there's good reason to believe that they could do that with the 50 still under the 200. And based on what we'll see in the IWMs. In fact, let's go to the IWMs next, because the IWMs are the fly in the ointment when we look at the major indexes. They just barely come back over their 50-day moving average, which is still negatively sloped, and they still are stuck underneath the resistance that's been the case since the August collapse. So IWMs on a daily basis seem to be kind of stuck. That said, if the IWMs break out above this ceiling here and run up to the 120, that's a pretty nice move, almost probably a 4% move there. And that would lend itself to a nice rally in the other markets as well. So the bulls really could look for the IWMs to move up to the 200, and then we see what happens from there. And they're going to find a lot of resistance up at that 200 level, because if you look at the weekly chart, that's going to line up with some prior daily highs, around that 121 level. That's the major level of resistance in the IWMs. All right, but the key here for the IWMs is not to fall apart. If the IWMs start to fall apart, then we will look for the other indexes probably to get weak as well. And the true test, as I said, will be whether or not those strong indexes can hold their key levels of support. So what's the key level of support? And I'm going to say this is probably the most important index to watch, is the SPYs. So if I had to watch one thing and one thing only, it would be, where are the SPYs trading relative to their 200-day moving average? Right now we've closed above it for 1 day. There's a little bit of a vacuum above from the last 2 days. When I say vacuum, I mean not a lot of trading. So for me, I would have said, even without seeing the 65-week, that the level the SPYs really need to hold is this prior support and resistance level around the 204 level. Well, it just so happens that that is also the 65-week level. So in a very simplistic way, you want to see the SPYs trade and hold above the 200-day moving average. And sometimes what's done is you take a range around the 200-day based on a percent or standard deviation or something. But for simplistic, both simplistic and the way it works out right now, the 204 level is the 65-week. It's also prior support that was broken and resistance that was tested. So as long as the SPYs stay above that level and the IWMs stay in a consolidation, I would consider the market healthy and range bound. On the bullish side, the market's going up. If it continues to go up, I wouldn't want to fight it. There's just as much reason to believe this thing could continue to go higher as there is, in my opinion, that it should roll over and come back down. You don't need to have an opinion there. These are the levels. As long as we're over 204, you can look up. It's much more bullish, however, if we're over the 200-day. All right. Now, if we throw the Dow into the mix, it's very similar to the SPYs. It doesn't have the same easily defined price level based on previous action. But if we use the 65 week as that lower band under the 200-day, that's what I would focus on. Now, from a practical perspective, it would be reasonable to expect that the markets are not just going to go straight through to new highs, primarily because there is still a fair amount of momentum as measured by the 50-day moving average here to the downside. This has been a pretty impressive straight move up. Markets need to pull back, so any pullback should not come as unexpected just based on the way the markets are lined up. And in fact, if you want to look for what could the deep pullback be and still have the markets be positive, it would be a retracement to the 50-day. Now in the Dow, that's a pretty substantial retracement back down into this move to the upside, and I realize that is well below the band that I'm suggesting. The same is true of the SPY. If the SPY were to start to pull back on next week, I'm talking about a pullback that would bring us all the way back below 200, and the bears would be screaming victory if that were to be the case. And I would, in fact, look at the markets. Like I said, if it comes back under that 204 level, I'd look at them in a somewhat uh, bearish way, and look for the 50 to be its next primary objective of support. All right, but that's going weeks out. And so let's just try and focus on what to focus on in the shorter term. And those are the bands I would focus on in those particular indexes. Now, there's a couple of other things I would focus on, and that is what's leading. And before we go to what's leading, one of the reasons to look bullish is this chart. And we've talked about this chart before, and you can find this chart in Little Big View under Sector Summary. In fact, I'll pull it up right here for you. And if you get stocks and commodities, you might want to check out stocks and commodities this month. Little Big View was written up. They really liked it, so that'll give you a sense of what's in here as well. So if you go in Little Big View, you can find it at our homepage by going to the resources section, Little Big View, and then if you go to Sector Summary, you will see this same chart. It's updated weekly right here. Now I put the 65 week on the chart that we're looking at now, and I might add that to the image that we put up here, and this will give you a little bit more history as well of this chart and how the whole thing works. So that's where you can find it week to week if we're not mentioning it in Outlook, which probably won't every week. But the importance of this chart is that it's looking at the industry groups that are tracked on this page, and this page is just tracking the basic sector industry groups. All right, so it's not all of them, but it's 14 of the majors, and the chart below it adds up how many of them are bullish over the last 6 months, positive return over the last 6 months, and how many are bearish. So the number of bullish is the green line, and the number of bearish is the red line. Now, if you go back and look at history, if you've had a market that is below the 200-day moving average and has less than 4, which is this yellow, less than 3 or less industry groups that are bullish, the market has had a bearish tone to it. So simple rules would be under the 200 you're bearish, under the 200 with fewer than 4 positive industry groups, 4 out of 14, then you're definitely bearish. So this is a significant week. We've come back through the 200, and it's the second week in a row with 5 of the industry groups having a positive 6-month change. So I would look at, what are these industry groups that are leading? Which one of these are the positive ones? And we can see those right here, 6 month. So we've got XLY, XLK, XLP. Now XLU might be considered somewhat defensive, so that's not as impressive. And XLF are all positive. And XHB, now these are modestly positive, but we want to focus on what those are doing and what these leaders are doing. Are they continuing to lead, or are they getting weak? So let's take a look at those charts, and that's the other place I would look to measure the health in a really simple way going forward. So let's start with the XLPs, or actually let's start with the XLYs, consumer discretionary. And you'll notice they've gotten all the way up to their 2015 highs. So these have been really strong. They're well above their 200. Now these too are ripe for a pullback because of the nice move, but these are the ones we want to continue to hold up. Keep in mind, consumers, what did I say we're leading? Consumers, technology, financials. That's not so bad. If we had to look for the groups to lead a new leg of the market higher, those would be definitely be high on my list for choices to move us higher. So XLP, again, consumers, this is the staples, looks very similar. Now, it's gone straight up. It could go straight back down. Look for support in and around the 50 level. So if it pulls back anywhere close to 50, I still consider it healthy. All right, XLF. Now, XLF doesn't look nearly as good as KRE. So we'll take a look at KRE. XLF is coming back, but definitely one worth keeping an eye on, because if this rolls over at the 200, it never got back over the 200, but it does happen to be flat for the 6-month period. But KRE, the regional banks, is looking much better. All right, so I would keep an eye on KRE. If it's the stronger financial one, let's make sure it stays strong. So as long as this thing stays above its 200-day moving average, again, that's the gray line on the left, I would say all is well in KRE land, and that's a pretty good group to be leading us. All right, so those are the groups I'd keep an eye on. Those are the levels I'd keep an eye on. Now, in terms of market internals, I don't want to completely throw you for a loop, but I'm going to show you something that might be a little counterintuitive, but it's worth watching. And that is, we look at the McClellan typically as overbought would be when you start looking for the market to turn lower, and oversold would be when you start looking for the market to go higher, right? Makes total sense, and that's true. However, there's another pattern that you need to watch out for in the McClellan, and this is true of any market breadth indicator. And that is, if you have a market, so in this market, it got really overbought here, but that's a good thing. It's a good thing because the market was coming off a pretty significant low, right? So when you have an initial rally off the low, you want to see the market get overbought. That's good. What you don't want to see in a market that continues to go higher is a market breadth indicator that continues to go lower, which makes sense, right? If you think about it, market breadth is telling you how many of the stocks underlying the index are moving higher relative to moving lower. So you want this number to climb, but clearly it can't climb forever, or you'd be completely overbought. So what healthy markets do is they expand in price, and then they expand in breadth, and then they consolidate in price, and they decline in breadth. But what can happen, and what is potentially happening here, but certainly could happen over the next week or two, is if the price continues to climb here, we need to see the McClellan turn and start turning back up. It would actually be better than if it continues to head down towards zero. Let me give you an example of a couple of times when this has happened in history. Okay, so here's a scenario, not unlike what we've just seen, where the market came from an extremely oversold position and got overbought, and that's great, right? It gets, let's call it overbought in here. Great, that's what you want. Now, the market, however, continued to go up, and the McClellan had a little bit of a rally here, but really by the time it got up here, the McClellan was under zero, and it really had not had any kind of a rest, right? So that's telling you that during this whole time, the underlying strength of the market was getting weaker and weaker and weaker. All right, now that means that when the market starts to sell off, the market's already weak, and you can get what you got here, which is a pretty significant quick drop. So if you're looking at McClellan and you're saying, oh, it's okay, we're sitting in the middle, you don't want to be sitting in the middle if you haven't had the right action getting there. Now, I know this is a little bit of a nuance, and it it really is only applicable in these specific situations where the market continues to go higher. All right, and here's another one right here where the market just kind of continued to go higher in an environment where the McClellan just continued to go straight down below zero. Right now, so when that happens, then when the market starts to roll over, it might be a little bit more of a correction than you really were bargaining for. So that's not good. Now, and I'm not saying we're there yet, but that's what we want to keep an eye on with the McClellan. You want to see it get more overbought if the market gets overbought. Okay, it doesn't mean just because you get really overbought doesn't mean you have to have a big correction to work it off. We could get really overbought and the market could go sideways for a couple weeks, and that's how the McClellan and the breadth gets worked off, and that would be a much healthier way for the market to act. Right now, the other way to kind of sniff this out, the other way you might see this happen is in the new highs number. Now, the new highs number is not one we probably talk about like this very often, but I do mention it in my blog once in a while, and we have a chart that replicates this kind of percent of new highs versus new lows number, and this under 30 and the 70 level are the two key levels. This is a chart in Little Big View, but what you don't see in Little Big View is a total number of new highs, and it's too bad we can't show you that. And the key here, what I want to point out here is that the ratio of new highs to new lows turned from bearish to bullish when it went over 30, right in around here. And that's exactly what we wanted to see. But I've said in a video where I pointed this out, the one problem with it has been that we haven't had that many new highs or new lows. As you can see, these are the numbers here. New highs are in blue, new lows are in red. And if we don't, in my opinion, if we don't have more than 100 of one or the other, then it's not as significant. So we really haven't had 100 new highs until recently, till this week. So that's a good thing. And that's my point. We need to continue to see more than 100 new highs if you're going to have a healthy new leg up. If we have a new leg up and if the market continues to go higher, but the total number of new highs falls back under 100 on a regular basis, then the move higher will not be sustainable, and we'll need to have a correction. This is what that chart looks like on the SPY. So you can see we're just getting up there. Maybe I can show you a situation where I think that there's an easier one in the Qs, but you can kind of see if you look back at these numbers where just focus on the blues. The red line here is 100, the horizontal line. So this is okay, but again, that's not really great action, but at least it's somewhat positive. You can see when the market starts to trend higher, your new highs, they're going to whack around, but on balance, they're staying above 100. And then you get a prolonged period here of less than 100, and you can also see at this point your new lows become 100. And look at where they switch in the market action. This is not brand new high in the market, and we've got 100 new lows and less than 100 new highs. That is a huge warning sign right there. And I suppose something like that could develop over time here. We're not near that yet, but the thing is, if we continue to make new progress here, and the new highs drops down below 100, that would not be good. And if new lows go back over 100 as we're moving up or rolling over, that would be a worrisome sign too. And let's just take a look at it. You could do that same analysis on both NASDAQ and New York. And NASDAQ has a better example, I think, of situations where we've had periods, and maybe it was in here. Yeah, that was the same period where it dropped below 100 for a while, and the markets were flat, and it was just kind of a heads up. And that's what I'm saying. It's not 1 day or 2 days. It would be, we spend a week moving higher, and the new highs drop to below 100 for that week. It's a heads up, and what it's saying is the same exact thing as I was just pointing out with McClellan. The underlying market is going in a different direction than the prices, the index price. Do I think that's going to happen? I have no idea. But like I said, let's keep it really simple. The price levels I outlined are the levels that until we break below those levels, I think you should be constructive on the market. Keep an eye on those major industry groups. How many industry groups are 6-month positive? And then for the McClellan, let's just make sure that, when we look at it next week, if the market's higher, the McClellan's also higher. And keep an eye on that new high list. 100 new highs is good. Under 100 new highs, not so good. 100 new lows, watch out. All right, it's as easy as that, and I hope that helps, and we'll see you in the next video.